Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Thursday, November 18th, 2021, and I'm pre-recording this Trading Places Live for just a little bit later this morning. Currently, we've got futures up. Give you the latest there. And we still got probably a good close to 2 hours before the market opens, but Dow futures currently are up 37, S&P 500 futures up 13, NASDAQ futures up almost 90, led by a big report, earnings report from NVIDIA. NVIDIA has been a big leader in the market. I expected a big report out of NVIDIA, and we certainly have gotten that. Big gap up. We'll see if we get a breakout there. We'll be talking about NVIDIA a little bit later during our earnings spotlight segment. And while I'm talking about it, let's go through that agenda for today. First up, the daily market recap, as always. Take a look at what happened yesterday. Then we'll get into talking technically. I'm going to take a look at some retail stocks for you and retail areas of the market. Chart lists. Later tonight, we're going to be having our new draft at Earnings Beats for our 4 portfolios. We put 10 equal weighted stocks in 4 different portfolios, and then we hold them for 90 days. We've been crushing the S&P 500 over the past few years, and that draft occurs tonight where we will be selecting the 10 stocks to go into each portfolio. I'm going to show you a little bit about those portfolios if you're not aware of it. So we'll go through that in chart list. Then we've got earnings spotlight where we'll talk about NVIDIA and some others. Some big responses to earnings in both directions, but we'll go over those later in the show, and then we'll wrap up the show with the 3 you must see. I got 3 good charts for you. So hopefully you'll stick around. Let's go ahead and get into things. Before I jump into the agenda, though, let me take you over to earningsbeats.com, where if you are new to Earnings Beats, I want to make everyone aware we have our fall special going on right now. This is not only our best deal of the year, but I believe it's the best deal we've ever offered at Earnings Beats. We've had a lot of members ask us if we would be willing to go out more than 1 year for a discount, and that's exactly what we've done this year or in this fall. So we have 1 year of our service for $9.97, which works out to $71 a month. When you consider you get 2 free bonus months, you're getting 14 months. If you go out 2 years, so $9.97 times 2, you get 6 free months, which takes you down to $66 a month. And then 3 years, you pay the $9.97 for 3 years. You get 1 bonus year in advance. So for 4 years, you're paying $62 a month, essentially. That compares, by the way, to our normal monthly rate down here that you see of $147 a month. So that's a lot of savings, depending on how long you want to go out. But we love the service. I think most of our members love the service. I can tell you that probably 90% of our members, if not more, have annual deals, which makes sense. It's a lot cheaper. But anyway, we did give this offer to go out further. If you want to save more, completely up to you. We just want to make sure everyone is aware that we are running this. It is valid through Saturday, November 27th. So you still got some time to act on it. This is a great time, actually, to come in with a free trial, because if you come in with a free trial right now, you're there for our draft later tonight, and then you can evaluate the service all the way up until November 27th to see if this is something that you would be interested in. So we hope you'll join us. You can start your no-cost trial. It's a zero-cost 30-day trial. So you'll be able to come in and, if nothing else, get the 40 stocks that we're going to have in our 4 portfolios for the next 90 days. So you can check that out there. Scroll down further. If you're completely new to Earnings Beats, you just want to kind of see what we're all about, I would suggest taking us up on this Earnings Beats Digest newsletter. It's completely free. No credit card required. You can unsubscribe at any time. It simply is a newsletter that I write, very brief, usually just a couple paragraphs, quick little paragraphs and a chart. So it's very easy to digest very quickly in the morning. Mondays, Wednesdays, and Fridays is when I write it and we publish it. And normally it's out around 8:30 in the morning, so about an hour before the stock market opens. We talk about things like earnings. We talk about relative strength. We talk about candlesticks. We talk about all kinds of different things. But check it out. I think it's a very educational piece and sometimes provides trading candidates for those who are interested in trading as well. All right, let's move on. I want to go through and talk a little bit about what happened on Wednesday. We saw the Dow Jones Industrial Average fall 211 points. That was by far the worst performer among the three major indices, the Dow, the S&P, and the NASDAQ. The S&P fell 12, NASDAQ fell 52, but on a percentage basis, you could see both of those lower than the Dow, excuse me. Mid caps, small caps actually got hit a little bit harder. Mid caps lost 22 points or 0.75%. Small caps down more than 1% yesterday, down 15 points. One thing I'll say, though, even though all of the indices went down, we do have all of them still above their rising 20-day EMAs, which is above their 50 days. So I think the configuration here is still looking pretty good. We are in option expiration week. I can't stress to you how volatile this can be. Yes, the market could still go higher, but there's a lot of in-the-money calls that net in-the-money calls when you strip out the in-the-money puts that could put pressure on the market to the downside, either toward the end of this week, last couple of days, or into next week. That's not unusual to see it carry into next week. And I get a question a lot, why would it go into next week if options expire on Friday? The reason it would go into next week is anyone who's holding calls has the option to exercise those calls. So if they exercise and they buy the underlying stock, market makers are still on the other side of the trade. They're still, at that point, they become shorts. Instead of selling calls to those who've been buying the calls, when those calls get exercised, now their market makers are on the other side as a short. So they still have financial interest for the stock to go down even into the following week. This isn't anything I'm making up. If you know, I've been following the stock market for a long time. I've got the S&P 500 every day's close on a spreadsheet since 1950. So I do a lot of analysis. And what I can tell you is that from the 19th of the month to the 25th of the month, those 7 days, every month, January all the way through December, those 7 days of each month, they have netted on the S&P 500 an annualized return of minus 8% since 1950. You think, oh, it's just a week. Well, it's a week every month. So it's basically almost 25% of the year. And when you consider that the S&P 500 goes up an average of 9% a year, but this period is actually lower by 8% on an annualized basis, that's telling you that the rest of the month is pretty darn strong, better than the 9%. That's the average is the 9%. So anyway, I just always like to focus. Now, I will say November and December tend to do better than the other months, but we've got other issues in the market. I mean, you can see these PPOs falling as prices are trying to break out. So we have a negative divergence, not technically a negative divergence because you need to close at a new high. We came up a little bit short of that, but still, I mean, we definitely see the PPO, which is stretched. When we look back the last several months, you can see the PPOs are as high as they've been. So this is the most bullish momentum we've seen. So we're just a little stretched, and a pullback would not be a bad thing. Anyway, moving on, sectors. Real estate up 2/3%. Discretionary almost 2/3%. Healthcare up just fractionally, up a little bit more than 1/10%. To the downside, energy and financials. Energy down 1.5%, and energy closing at 57.23, which was below the 20-day EMA. It's got some pretty decent support here, right around $57. Really like to see that hold. And I don't know if you've been watching, but the US dollar has been breaking out and moving higher. That provides headwinds for both energy and materials historically. Doesn't mean they can't go higher, but on a relative basis, they tend to underperform when the dollar is strengthening. And that's no different than what we're seeing right now, especially with energy, as energy has been struggling. It looks like it's trying to roll over here. All right, the 10-year Treasury yield. Before I look at this chart, I will tell you that later this morning, we have initial jobless claims coming out. Expectation there, 261,000 jobs or claims. Last week, 267,000. So we're expecting that number to continue to drop. Wasn't long ago, we were way, way higher than this, up in the many hundreds of thousands. I think in the midst of the pandemic, I think we had a reading of like 3 million. So back down to 261,000. Those numbers definitely heading in the right direction. November Philadelphia Fed Manufacturing Index, 21.4 is the expectation, which would represent a drop from October of 23.8. And then finally, October leading indicators out at 10 a.m. this morning. The other two will be out at 8:30. But October leading indicators, out at 10 a.m. expected to rise 0.8%. September rose 0.2%. So we're looking for things to pick up there. Looking at the 10-year Treasury yield, I mean, honestly, I think that what the yield's been doing is kind of nirvana for equities. We're still down near historic lows. And yes, we made a move up back at the beginning of 2021, but then we fell. And now we're just kind of range bound between maybe 1.15, and I'm talking intermediate term range bound, 1.15 and 1.75. I'd say shorter term, I'm looking maybe at about 138, 140, up to maybe this 170 or 175 level. So I think in the midterm, medium term, intermediate term, or even short term, we've got this range that maybe 35 basis points, but we're down still near historic lows. That I can't stress enough. Rates have been so low, we forget where rates have been in the past. But historically, the stock market is okay as long as rates don't go shooting up, and as long as they remain below about 5 or 6%. Stock market has tended to do pretty well in that environment. So that's why I say it's kind of nirvana. If inflation were the problem that the media is trying to tell us about, these yields would be skyrocketing, because nobody wants to hold a bond yielding 1.6% if you believe inflation is going to be 5, 6, 8, 10% extended for a long period of time. Why would you want to earn 1.6% on your money while you're losing 10% or 8% purchasing power? It makes no sense. So when the bond market, when the inflation is a big problem, those in the bond market sell. Yields go through the roof. That's how the Fed fights inflation. The yields go up, and that's usually a precursor to the Fed getting much tighter with their policy. That's not what we're seeing. And I'm going to follow the charts every single time over a headline article from a media outlet that probably doesn't even follow the stock market most of the time. They're just looking for clicks. You got to be careful. You don't want to get suckered into that. So anyway, I think that what's going on with the yields still excellent for U.S. equities. And the yield is actually moving up again faster in the U.S. than it against Germany's 10-year Treasury yield. And that tends to be a sign of, that tends to be a precursor to a strengthening dollar. So everything's lining up for the market to go up, energy and materials to lag on a relative basis. And that's what I'd be looking for into the balance of 2021 and perhaps into the early part of 2022. All right, let's move on. I'm going to move into the talking technically segment, and just want to talk a little bit about retail stocks. I'm not going to spend much time here, but retail stocks, you can see the XRT. We had a really good report that came out earlier this week on the retail numbers. I believe we've broken out of this sideways consolidation. So any pullback, I think if you get it down to this 20-day or perhaps even down to about 97.5, which is about where we broke out from, 97.5, 98, I think the 20-day down to that, and the 20-day right now is at 99 and change. So let's just say 98, 99 in that range, I think is a great entry into real estate, into retail. So the XRT, which had broken out, pulled back yesterday 2%, but I'm fine with that. I think if it pulls back a little bit further and dips below 100, I think that could set some things up really nicely in the retail area. So let's talk about some of the industry groups, in retail or related to retail. Let's go first with specialty retail. And I'm going to show this. I'm going to get rid of the AD line. I'm going to show this relative to the S&P 500. So we can see what's been leading and what hasn't, maybe what's turning the corner, that sort of thing. So let's pull this up. And clearly, specialty retail already had been strong. So now we've got overall retail breaking out. And this has been a strong area where we already have seen a 52-week relative high to the S&P 500. When I talk about ChartLists later, one of the things I do in coming up with the 10 equal weighted stocks for each of our portfolios is I first look at the industry groups that are strong. Because what I really want to do in these portfolios, the way to outperform the S&P 500 over time, in my opinion, is to beat it with leading stocks and leading industry groups. So Seeing this tells me this is an area that I want to focus on. I want to consider some of these specialty retailers that are actually outperforming their specialty retail peers, because that's where you get leading stocks and leading industry groups. Anyhow, I think specialty retail looks good. Is it overbought? Yeah, it has a slight negative divergence right here. So we could see a pullback. There's no doubt about it, but I would be a buyer into that weakness if we see it. Broadline retail. And when I see this, I start thinking about Amazon. And you can see the chart actually looks a lot like Amazon if we were to pull that chart up. But broadline retail, big move up here over the course of the last month and a half or so, starting to strengthen. The PPO looks good, but relative strength, it's just kind of going along with the S&P. Do you see the difference? Broadline retail is not being treated the same as specialty retail on Wall Street. Broadline retail has been downtrending versus the S&P 500. So it's going to be harder to outperform with broadline retail. If you've owned Amazon over the last year, while it's been going sideways, you're underperforming. It's making it tougher for your portfolio to outperform the S&P 500. And I love Amazon. I think Amazon's a great company. I think we're eventually going to break out. And I think it's a great company to hold, even if you've had a rough year where you're not gaining much, because I think eventually we're getting that breakout on Amazon, and I think we go a bunch higher. But for now, Amazon's lackluster performance is holding back broadline retail, and you can see it in this chart. How about clothing and accessories? So the USCF, sideways consolidation, but look what's happened. Along with the XRT, which is a widely diversified retail ETF, the clothing and accessories group has also just broken out. Volume confirming, and look at the relative strength. Now this one has made it to about a 5 or 6 month relative high. So that's pretty good. It's not as good as retail or specialty retail, but it's still pretty strong. So this is a group that I think looks very interesting. How about apparel retailers? Apparel retail going sideways, relative strength going down, although we're trying to move up to about a 6-7 week relative high right now. So things have improved, but we haven't made that breakout yet. So I don't like this one as much. And then there's home improvements. These home improvement retailers, Home Depot and Lowe's, the last couple of days, they have blown their earnings estimates out of the water. And as a result, we've gotten a breakout of a bull flag. Here's your flagpole. There's that flag. And we just got a breakout. So we're probably looking at maybe another 50 to 75 points on this move I would be looking for. So I think 900 to 925 is certainly within the realm of short-term possibilities. So, and look at the group breaking out on a relative basis. So Home Depot and Lowe's, yeah, there's a decent chance we might see one of those or maybe both of those in our portfolios. One last thing I'll just mention here. If you want to look at individual stocks within any of these groups, one thing you can do is go in. I like to go into this scooter report, which is down under member tools, under summary pages. You just scroll down, find this. And then, for instance, large cap stocks, if I type in home improvement, it's already in scooter order. So I just started to type home improvement. There you have it. Lowe's, Floor and Decor Holdings, and Home Depot. There are your 3 big winners. So you can take any of these groups that I just talked about. Clothing and accessories. Let's do that one. Clothing. All right, we already have them lined up here. So Lululemon, 93 scooter. Tapestry, 71.1. So it's a little bit further down. But then you just pull up the charts, take a look at them and see what you think. So you pull up Lululemon, 93 scooter. Yeah, trending higher. Does have a little negative divergence. So I'd probably be a little bit skeptical here in the near term. But a pullback anywhere close to this 440 to 450 area, I'd be building a position in Lululemon based on, what's been going on. So, yeah, this is going to be an interesting draft tonight. So let's go ahead and move on. Let's talk about this draft a little bit. So I'm going to show you the stocks in our portfolios currently. Now, we're going to have the draft tonight, but the actual buying of the positions from our standpoint at Earnings Beats will take place at the close on Friday. So we'll just be giving them out to our members a day early. But whatever these stocks close at on Friday, the ones I'm showing you now, they come off of our portfolios, and whichever ones we go over tonight at the draft, we will add tomorrow at the close. And they'll all be equal weighted, 10 equal weighted stocks in each portfolio. So these are the ones that were in the model portfolio. What I'm going to do is just bring these up on a summary basis so you can see all 10 stocks at one time, kind of get a feel for what we do here, the sectors. I want you to notice a couple things. I'm going to pull this up going back the last 3 months so that you can see how these have performed. Now, this isn't exactly how we've done because this goes back 3 months, and technically it started on August 19th, and 3 months will take us back to August 17th. So it's not exactly, but it'll give you a pretty good idea of how our portfolios have performed. What I always tell folks is that our portfolios, it would be great if all 10 stocks in each portfolio went higher. But the reality is when you're going with leading stocks and leading groups, you're going to see a number of these stocks are overbought. And so as a result, you'll get some sideways consolidation out of some of these. Some will get an actual pullbacks. I mean, Snap had a bad report. So that one we got hit pretty hard in our model portfolio. But this portfolio has outperformed the S&P 500 just barely this quarter, but quite a bit over time. I'll go back over again to the, I'll show you the performance of our portfolios. But the model right now is up 6.79% this quarter, which our quarter is August 19th to November 19th, which is through tomorrow's close. But there's your model portfolio this quarter. Basically the same as the S&P. We were down for most of the quarter. We actually just came back and took the lead. But look at our aggressive portfolio, and I'll show you those stocks in just a second. Up 23% versus the S&P 6%. Our income portfolio trailing a little bit, which is more value oriented because they're dividend payers. And right now it's about growth stocks. Strong AD, getting back to more growth stocks, 14%, 6% on the S&P. So again, outperformance. This is what we've done over time. So we've got the since inception results. Model portfolio, you can see, has absolutely crushed the S&P 500. Aggressives more than doubled. Strong ADs up, almost 50% higher, 60 versus 84%. Income, like I said, it's been a growth-oriented type of market. So our value-oriented income portfolio hasn't done as well. But it's not nearly as volatile either. So it just depends on what your, what your goals are. But you can see that's how the performance is for this quarter. And so now I'm showing you the stocks that are making up the portfolio. And when you look at this, you're going to see how many energy stocks do you see in here? 0. Material stocks, 0. Consumer staple stocks, 0. Utilities, 0. Real estate, 0. In a secular bull market, we want to be in the areas that outperform the S&P 500 during secular bull markets. And that generally comes down to the aggressive sectors: technology, discretionary, healthcare, technology, discretionary, communication services, financials, and industrials. And that's what we have in here. The only one that's outside of that is healthcare. It's done for a reason. Now, the other thing you'll notice is that even though we have, in this case, 3 technology stocks, one's a semiconductor, one's a software company, one's computer hardware. It's not like we're loading it up with software or with just semiconductors, but you want to be in some of these areas. Look at the semiconductor we selected, AMD, for a model portfolio, up 40% this quarter. That, along with Crocs, those 2 stocks, if you add them up, that's 67%. And that's 20% of our portfolio right there. I mean, that's going to help us outperform. Now, we did have a couple of not so great stocks, and that's why the model portfolio was kind of, just kind of even with the S&P. Let me show you the aggressive. I'll go through these others a little bit quicker so we can get through. But look at this, Macy's, which just reported earnings, by the way. We'll talk about that in just a minute, but they easily beat. Macy's up 70% this quarter. Synaptic 60%, NVIDIA 50%. And by the way, they're spiking today, up, $20, $25 or something. I don't know what their number is right now, but NVIDIA is up really nicely. The stock's already up 50% even before today's earnings related jump. Datadog 43%. Here's the home improvement stock I was just talking about, 20%. And you can see 9 out of 10 went up. We did have one really bad one, Moderna. And by the way, Moderna was doing really well until they came out with their earnings, and then they kind of fell apart on us. But it's the equal weighting, and you can see why this portfolio has done so well. Income portfolio, you're going to see more dividend payers. The best performer, Microsoft. That's kind of the growth element of this portfolio. And thank goodness we put it in there, or we'd have had a much rougher time. If you get down to some of these, Whirlpool, even Wells Fargo, Cisco, Nike came back for us. It was struggling for a while. Starbucks, a little bit of growth there. IPG, and then we actually had a utility in here. These are more dividend payers. They're not going to be the big movers, and you can see it's reflected in their performance. We didn't have any big losers, but outside of Microsoft, we really didn't. I mean, EFX did okay for us, but really didn't do a whole lot either way. It was just, slight strength there. Strong AD, Cloudflare, 77%. Lending Corp, or Lending Club Corp, 59, almost 60%. And when I talk about strong AD, what I'm looking at is the AD line. So in order to be selected for this portfolio, the very first filter, you have to have a strong AD line. So there's net. Let me show you LC. LC in August, you can see was setting a high. I'm still comfortable with this. I'd rather see it breaking out, but it's still kind of sideways consolidating. I probably wouldn't pick it again for the strong AD portfolio because I'd really like to see it breaking out. But stock's been consolidating actually back down to a key gap support area. So I wouldn't be surprised to see us move back up again and see this take off. But anyway, those are the portfolios. So check us out over to Earnings Beats. Would love to have you come over, sign up for that no-cost trial, and then you can check out our service for 30 days. And if you like it, over the next 10 days, you can sign up for using our fall special to some big savings. But come in for tonight's draft and see what we've got for the next 90 days. You'll have the 40 stocks, whether you stay with us or not. Anyhow, let's keep moving, running out of time here. So earnings, I'm going to go through these kind of quick, but let me pull up just a couple of these that I wanted to show you this morning. NVIDIA up 23 points to 316, up 8%. Need to get through about 322 though. This one, you got to be careful. A lot of in the money calls. We could see reversal after the gap up. I'd be a little concerned. Cisco did beat 82 cents versus 81. Market didn't care. Down 6% this morning. Copart, CPRT. This is a stock that's been doing pretty well. I'm not seeing a reaction just yet on the stock reported yesterday though. Victoria's Secret, smaller company, but stock up 10, almost 11% today. Looks like maybe it's reversing its downtrend. This morning, I mentioned Macy's. Just wanted to show you the reaction there. This is another one of our portfolio stocks. Macy up $3, another 10%. That's going to certainly help us this morning. Last one I'll show you is KSS, which is Kohl's. Kohl's up almost 9% this morning, breaking out potentially above the $60 level. All right, moving on to the three you must see. Going to go through these very quickly. BDX. Going to show you on a relative chart here. Actually, doesn't really matter on this one, the relative chart. What is interesting is notice all of these bottoms that came in between 235 and 237.50. That's been holding. We're seeing strength now, volume picking up. If we break above 250, it looks like we're probably going to head to the top of this range, up between 260, 250 and 265. That has been a range that's been holding all year, and that's what I'd look for to continue. Home builders, you might not realize this, but seasonally, home builders love November, December, and January. So watch DR Horton. DR Horton's been strengthening. Any trip down to the 20-day I like. I think it's making a run for this area around 105. And if the seasonal patterns hold true, I would expect DHI to make a breakout here as we head into 2022. Last one, big reversal off yesterday's low. This is C Limited, ticker symbol SE. You can see the support level there. Higher high, higher low, higher high. We wanted to hold that low, and we did with big volume and a hammer. Look for a reversal there. All right, that's it. Appreciate you tuning in. Please check us out over at Earnings Beats. I'd love to have you for tonight's webinar. Happy trading, everybody.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.